So, I thought we'd go live here to discuss obviously what happened yesterday, which is a very big change in terms of with the different rates of the Federal Reserve and also with the Bank of England changing their rates yesterday by pulling them up. I thought I could potentially make a TikTok talking about this, but that would probably be quite long. So I thought maybe a live stream would be a bit better. If anyone chooses to join, which is entirely up to you, you can feel free to ask your questions and I of course will try and answer them to the best of my ability. Not financial advice. Apparently I have to swipe. Okay. That makes sense. So what happened yesterday then? Well, we saw the Federal Reserve increase their base rate of interest by 0.75%. So that took the rate from... someone's joined. Hello. I'll start again. So as I was just saying, we saw yesterday the Federal Reserve increase the base rate of interest by 0.75%. Their current range is between 3.75 to 4% for that base rate of interest. We then saw the Bank of England follow suit. So the Bank of England as well increased by 0.75% up to 3%. And that was the biggest rate hike in the UK since 1989. The Federal Reserve's hike was the biggest in 14 years, so a very considerable one. If you do have any questions about any of that, feel free to drop it down below. So in today's video, I wanted to talk about why they've done that, the effects that's going to have on individuals who are maybe investors, but also to the laypersons, and also how long this will last, because no one's really sure at the moment how long this is going on. So I'm going to have a bit of a discussion and maybe some musings about what happened. Now, it's my first time using TikTok Live, so bear with me as we go through this together. I think people are here, but I'm not entirely sure. If you are, then maybe drop a comment. I'm not sure where they come up, but I'm assuming they would pop up. And we'll see how we get on. So what are they trying to do here? So why are the rates rising? Well, in short, it's to control inflation. So the primary purpose of monetary policy is to control the supply of money. And when there's inflation, what that basically means is the value of money is declining because prices in the economy are rising. So if we showed this on a diagram, what they're aiming to do is change demand. So they're trying to impact aggregate demand. I see some people welcoming. Hello, all of you. Suf or philosophy was Suf. Very good. So top right. And there is someone with me here as well. So thank you for that. That's very helpful. Leave your tips as well. So what they're trying to do at the moment is they're saying basically there's too much inflation. So we have a price level and an output level. Let's say it looks like this. So it's P and Y2. What we're then going to see is they're going to try and contract this. And one way they're going to contract this is by putting interest rates up. What that basically means is that people have less disposable income. If they have less disposable income, they spend less money, and thus aggregate demand in the economy is going to go down. So we're going to see a downward shift to AD2 and an accompanying fall in price levels to P2. So we see that on the diagram here. So it falls. But there's a slight problem with the way they're doing this because we know that the type of inflation we have today... interesting. So I need to mirror my camera. Bottom right, thank you. More... is it settings? Bottom right. Is it enhance? No, that's flip. Mirror your video. Very good. Thank you very much, Suf. I hope I'm saying that right. So let me show you the diagram again. So what we were just saying is basically they're trying to push aggregate demand down. Now I need to remember to go the opposite way. So they're trying to shift aggregate demand down. However, that's not going to work in the current climate we're in because what's causing inflation? Well, inflation at the moment is being caused by supply side issues. It's cost push inflation. So what we're going to see then is actually that our LRIS is shifting backwards. And that is what's causing the price rises. So AD, Y1, Y2, P1, P2. So we see here, what's causing the prices to go up is a contraction in LRIS. So LRIS is moving backwards, which is then causing our price level to go up. So what they're trying to do is target demand. Well, if we show the same shift that the Federal Reserve and the Bank of England are doing by trying to shift demand inwards to AD2, we see that this will decrease price levels, But look at the massive negative effect of doing this, which is price levels are going to go down and our GDP is going to go down considerably more. So it's going to have shifted originally from Y1 to Y2, so growth is falling, but then after that down to Y3. So you're going to have a significant negative effect on the economy. And I like to describe this as kind of a very draconian policy. It's a very brutal way of controlling the markets and the economy in order to control the current state of the economy or the current state of inflation. Let's talk about the effects of this a little bit. One thing to note, which I don't think I said at the beginning, was actually the European Central Bank, the current interest rate there is 2%. So they increased that by 0.5% from 1.5 to 2% back in October. But that's obviously lagging behind a bit the high of the Federal Reserve, which is 4%, and the Bank of England, which is currently at 3%. I've got people commenting. Very good. So I can see big comments there. Fantastic. So the first thing to talk about is actually the effects this is going to have on interest rates. The effects it's going to have on exchange rates. So we know that if you put up interest rates, what's that going to do? Well, it's going to attract people to join your economy, to come into your economy. So by the Federal Reserve putting up interest rates, that means that more investors are going to move their money into the United States, because now the bank accounts have higher interest rates, and also the bond market is going to be more rewarding. The yield on US Treasury bonds is going to go up because of that rise in the base rate of inflation. So what we're going to see then is an appreciation in the dollar. And we know that any appreciation has to be mirrored with a depreciation in another currency. And this is why we kind of see this franticness at the moment to catch up with the Federal Reserve, because as we have seen the Federal Reserve put their interest rates up, the other world economies have to follow them. Otherwise, they're going to be left behind, and you're going to kind of see a run on the value of your exchange rate. So that's one of the first immediate impacts we're going to see, is a correction or a change to the exchange rate. And that can have positive and negative effects. So you may have heard this term exporting inflation. And this is part of kind of the accusation towards the Federal Reserve that they're harming emerging and developing economies by kind of exporting inflation to other countries through the exchange rate mechanism. I might make a separate video on that, talking about that in a bit more depth, because there's quite a lot of levels to it. But fundamentally, that is a concern that we should talk about. But what does a rate rise actually mean for you guys at home and me myself, to kind of the layperson? Well, there's quite a lot of interesting effects. So we know that, for example, Warren Buffett, who is a very famous investor and still is one of the founders of Berkshire Hathaway, he has this famous quote that basically goes, the interest rates act like gravity. So as interest rates change in the economy, we're going to see a change in how the economy is performing, how the different markets that we monitor, the stock market, the bond market, even the market for scarce resources like gold and precious metals, how they perform. So if interest rates are going to go up, we're likely to see actually the bond market become more profitable, because, as we said earlier, accompanying yields have to go up. So investors are going to move their money into bonds because they're now more profitable. But as a byproduct of that, what we traditionally see is the stock market go down. So your stocks are going to decrease as a result of this, because people are moving their money out of stocks and into safer bonds, because now with the interest rate rise, bonds are more appealing. The other things to mention as well is this is likely going to reduce government spending. And that's because, obviously, as we said, as interest rates go up, so too does the bond price. That price is the cost to a firm, is the cost to the government, of having to borrow money in order to spend on programs. So if I'm the government and I want to borrow money, I do that through a bond. It's now more expensive for me to buy that bond or to sell it effectively. I sell the bond to someone in exchange for them giving me the money in the assurance that I, as the government, will pay them back. So that has now become more expensive. So what we're going to see is probably a contraction in the amount of government spending. Now, if the government stops spending so much, what are we likely to see? Well, that's going to lead to cuts in, say, welfare payments, also cuts in, say, benefits, and also cuts in projects that the government are working on, so infrastructure projects. That doesn't seem like a very important thing maybe, but it really is. For one reason, in particular, living standards. If they're cutting welfare payments, if they're cutting benefits, normal everyday people are going to suffer because of that. And what we also know about normal everyday people is they spend a large proportion of their income. So when someone gives money out in terms of a welfare payment, so when the government give money out in welfare payments, what we see is actually a lot of that money ends up going straight back into the economy because those people spend and consume with that money. So of course, if the government are doing less welfare programs because it's now more costly, because the interest rates have gone up, that is going to lead to less aggregate demand, it's going to lead to less consumption, businesses would see less profit, and that is going to worsen the already existing signs of a recession we have in the market. I hope that all makes sense in terms of the effects on government spending and why we should be concerned with that. Also, if we just go back to this diagram just briefly, if you wanted to solve this diagram where we have this contraction in LRAS to the, for me, it's going to the left. I think for you, it should be going to the left too. Well, what you'd want to do is kind of shift this LRAS line back out. You want to try and push it out. And one of the ways the government can do that is through supply side policies. However, that's kind of not going to happen so much anymore because to finance those supply side policies, the government would have to borrow money. And we know that borrowing is going to be more expensive because the interest rates have gone out. Cool, I see a couple of people have joined. Anyone got any questions at this point before we move on? So we've talked about why the Federal Reserve and the Bank of England are doing this. We've also kind of talked about a couple of the effects, but there's some more I've made some notes on that we're going to go on to. And also, crucially, we're going to go on to at the end to talk about how long this might last or what's likely to happen there. Yeah, that's a really good question. I'm not sure if there's data either to support that, but so what Suf said is basically, is there data to support this idea that if there's a recession, does it result in a reduction in your marginal propensity to consume, I believe is what MPC is standing for there. So what that basically means, your marginal propensity to consume, we should probably look at the average propensity to consume, but because the marginal looks at when we have income changes. So if you give someone more income, how much more do they consume of that income? So if I gave you £1, how much of that pound would you spend in the economy on consumption? If it was 60p, then you'd have an MPC of 0.6. Whereas we probably would be more interested in the average propensity to consume, which is based on everyone's income in terms of your total income. So how much of your average income do you actually consume with? There definitely is evidence that confidence will affect that. And I mean, we can see that already, and it's a pretty well established principle. What would be interesting, I think, on Suf's comment is there evidence or data we can track concurrently? So can we look at, say, different indicators of confidence to kind of predict where confidence is going? And I think potentially there are, and potentially that is a part of economics and a part of investing that hasn't really been tapped into using what we call sentiment analysis. Now, sentiment analysis is basically where you can take different inputs, normally Twitter posts, and you can code them on how the post is feeling. So is it happy? Is it angry? By doing that, what you're able to do is kind of aggregate a load of Twitter posts together, which may be to do with the economy or economics and more just generally, and see the mood of the people who are posting that. And then see how the mood is then generally, and we can kind of extrapolate from that. So you could look at that. You could look at how people's moods are changing in a specific area, or how someone's mood is changing on Twitter towards a certain topic, and use that to try and predict, say, where the market's going. It would be quite complicated, and there's quite a lot of levels to that. But I think, I don't know about data to answer the question, but there's definitely clear evidence that confidence definitely does affect the market and does lead to a recession and a reduction in people's consumption. If you have more follow-up questions on that, please do add it onto there. Let's move on. The other thing to note, obviously, with interest rates is we're likely to see a change in the house price. And that makes quite a lot of sense, especially in the UK, because as interest rates change, so too does the rate that people pay on their mortgages. Now, in the US, this is a bit different. In fact, a follower of mine told me this. Around 90% of mortgages in the US are actually fixed. So the vast majority of mortgages in the US are fixed. So the effect on the housing market in the US might be slightly more delayed than what we see in the UK. But regardless, I think common sentiment now is the interest rate rise is going to lead to a reduction in demand for houses, which is obviously going to lead to a reduction in demand for houses, which means the price goes down. Okay. What's really interesting as well is actually we can kind of time this. I'm wondering if anyone knows how we can time this or what's coming up to time this. No? Okay. I'll have a brief sip if anyone knows the timing here. So, one of the big dates going forward is going to be February and March time, because actually a lot of mortgages, people who are on fixed mortgages, the timings for those fixed mortgages to expire is going to be February and March of next year. So that will be a real litmus test for what's going on in the market, and especially the housing market, because when those people are trying to refinance, obviously they may find themselves not being able to afford to refinance. And if that's the case, they're going to have to sell their property and move somewhere else, which will drive the prices down. Similarly, by that point, maybe interest rates would have stabilized, or maybe we will see actually a more robust market. Whether that's likely or not is an entirely different thing. But it's interesting to note that that will be occurring as we go into the new year. So we're going to see house prices change. We're also going to see mortgage rates change. The next question, which I think is an interesting follow-up to that, is how long can this last? How long can it be? Is this it? So we heard from the Federal Reserve that this was kind of the last hike that they really want to put forward. Like, this is the end of the changes to the interest rates. They don't really want to put them up anymore. But is that actually possible? Well, I'm skeptical, in all honesty, because I don't think they're able to, say, control inflation at the moment. And I don't think inflation is going anywhere anytime soon, really. And I think especially as we go into winter, this problem may exacerbate considerably. And that's primarily in some parts due to Mr. Putin. Because if Mr. Putin decides to turn off the gas supply to Europe or interrupt it any more than he already has, that is obviously going to lead to a massive jump in inflation in Europe, and that is going to have a concurrent effect on the global economy. If there's a recession in Europe, then you tend to see symptoms of that elsewhere. We've got a comment. Yes, exactly. So, but I mean, yes and no in terms of, so the question was, they have this 10 months to have, what we have is called the transmission mechanism. So the time it takes from the rate change to actually filter through to the economy. The only problem with that 10-month rule is obviously they're not going to sit around and wait if inflation continues to rise. And especially if we get a big economic shock, such as Europe having massive issues with gas supplies, that would then prompt the Fed to intervene more readily and more quickly, I would say. So yes and no. I also, as we sort of said, there's a weird transmission mechanism in the US because they're unable to use mortgage payments so well, because in the UK, obviously, more as a percentage of mortgage payments are variable than fixed, whereas in the US, 90% of them are fixed. So what we're more likely to see is actually the rate rise having less of an effect on aggregate demand in the US, less of an effect on consumption, and therefore they may have to put them up again. So yeah, so we could have that 10-month grace period, but I think it really does depend where the economy is going. And if, as I was just saying, we get to a point in winter where we do have gas supply issues, and that's then filtering through to the US economy, I think it's very likely that actually there's going to be high levels of inflation and also an interest rate adjustment to go with that. I think this also links to a video I put up before talking about fiscal policy, and perhaps the US will be unable to use fiscal policy to kind of solve the problems there. But on that, I think if we now take a European perspective here, I would be at the moment very cautious about Germany as a country in terms of investing, but also more generally, if I'm engaged in Germany in any way, shape or form, because of their current reliance on Russian oil and gas. And again, they are playing a very risky game there and sort of lining up in the way they did. That could have some very serious knock-on effects if we do start to see that gas pipe tightening anymore. However, I mean, there is an upside to that, and maybe you think the opposite. The Germans have always been very technologically advanced. I think it's quite likely that they'll be able to maybe solve their way out of this if they really put their minds to it, to say renewable, potentially also nuclear power, but that's very, very unlikely in Germany because the Green Party, the German Das Grüns, they won't have that. They won't support nuclear power, and that's been the way in Germany for many, many years. So it seems their only alternative, if we do see a shortage of gas, is to quickly move towards renewables, or alternatively to move towards nuclear. But that's not going to happen. So we could maybe use that to draw a line and say maybe renewable energy in Germany might be something that's quite interesting at the moment, given that they'll probably have a reliance on that in the near future. But again, I'm quite bearish on the German market at the moment. Just some comments coming through. Yeah, so I mean, the storage capacity argument is interesting. However, I don't think, again, it depends. And this is the big issue because it very much depends on what type of winter we get. If we get a very cold winter, then that would have a different effect than if we get a fairly moderate winter. But obviously, we've seen kind of recently with climate change and with changes in meteorological effects and meteorological phenomenons that we can see these kind of freak weather systems and they're becoming more common. Like, for example, the summer we just had being especially hot. Well, if we had a equal in sort of intensity cold winter, then that is obviously going to draw up the supply of gas rather quickly. I also think, again, we said just gas, but also there's a lot more to this, especially through, say, OPEC. If OPEC continue to kind of control the market for petrol and gasoline, that is going to lead to other issues with inflation as well. And we've seen an unwillingness of OPEC to kind of liberalize and open up the pumps too much. We've seen the Saudis saying no to the Americans. We've seen a cut in the amount of barrels of oil that OPEC are producing. So you could get multiple things coming at one time, which then cause a problem. Now, I'm not saying this is or isn't going to happen. It's just me having a discussion about stuff to consider. But even if we have the storage capacity, I think that storage capacity could be used up very quickly. And I do think there are more avenues for economic manipulation that Putin can use, which haven't yet been used yet. I think part of that is obviously because in response, Europe and the US could use sanctions in response. But regardless, I think that's outside what we're discussing here. The key thing is obviously with Germany, I would be cautious. I think that's what I have to say on that. On the flip side, what's also interesting is actually we've seen in Germany from an economic perspective some quite interesting changes in terms of policies to try and combat inflation. The most interesting of that was, I don't know if you guys have seen, the €9 train pass. So allowing people to use any commuter train for a month for €9. And that proved to be massively popular. It cut German emissions quite considerably in the month that it was in power and in place. And moreover, it also reduced use of cars massively. And the system was able to cope. So Deutsche Bahn was able to respond to that. There was capacity. It was quite busy, but they did have the ability to respond to that. So I think potentially we could actually see some quite interesting fiscal responses. And actually the fiscal responses of Germany could then be mirrored elsewhere, which obviously as people interested in economics, but also investors more broadly, it could be interesting to note the responses in Germany who may get hit first for then how the wider economy or how the future economy will react and economies in other geographical areas. It's always been the case kind of that Europe kind of follows Germany. So the German economic policy is then followed in the rest of Europe. Whether that will be the case here, it's yet to tell, but we have seen interesting policies come out of Germany. What about some opportunities then? So are there any opportunities here that aren't really being talked about? Well, one thing I would say is obviously what this is a big shift. It's a big change. And whenever we have a big economic change, whenever we have disruption in the economy, you tend to see the power balance in the economy changing. So some people, some countries rise up, other countries fall. We saw this back in 2008. So ever since the 2008 financial crisis, China used that crisis to basically become one of the fastest growing economies in the world. So in the 10 years from 2008 onwards, what we saw was double-digit GDP growth in China. And they were able to exploit that. I think exploit is the wrong word. Maybe benefit from that is a better word. So the Chinese were able to benefit from the disruption that was caused, a lot of European and US countries experiencing declines in their ability to export because of the recession. And China was able to capitalize on that and actually become kind of the export capital of the world almost. And that was obviously in response to the 2008 financial crisis. China has now got its own problems with the consistent issues with the pandemic and also with debt and housing issues which are going on. So again, China maybe would be the one who's going to fall with this economic turmoil. But my question to you is, well, who's going to rise? Who's going to grow out of 2022? It's probably going to be a country that is not seeing too high levels of inflation. It's probably going to be a country where they have spare capacity in the economy and it's relatively untapped. So what they're able to do is produce more and export more in response to declines in the amount of production in developed economies. It's probably going to be a country with a high level of spare labour and spare capacity of that labour, and also an economy with a fairly skilled labour force in order to respond with more technical forms of production. Regardless of what the economy is going to be, that's going to happen. So it might happen, maybe I should say. Yes, so possibly. Who knows? But I think with those indicators, that's what we can kind of assume from what's been happening here. In my opinion, it kind of seems like a long-term trend now that we're going to see high inflation in the West. That's a very bad term, but kind of the global West, if we can say that. And we're probably going to see higher interest rates for a sustained period of time, depending if there's not any geopolitical shocks in other areas. Okay, so if there is a decline in that place and there's a decline in China as well, then there's definitely places around the world where another economy can come to power, can come to influence and can benefit from that. One man's loss is always another man's gains. So yeah, that's kind of, I think, everything I wanted to talk about today. It's more kind of my ramblings. Of course, it's not financial advice in any shape or form, more just kind of my take on what's going on. Does anyone have any final questions though? I thought it'd be easy to do it in this context. I like that people have been engaging, so thank you all for commenting. It really does help me out. I think you could also I don't know how that works, but maybe it helps the algorithm. I have no idea. But does anyone have any final questions before we maybe end the stream there? Just while you do that, just a couple of things. I will be uploading this, well, I'll try to upload this to YouTube as well, to my YouTube channel. So if you want to rewatch or if you joined late, you can do it there. I think you can also do that on TikTok, but I need to look into that. I feel very old when I say that. So yeah, I will be doing that. Also, if you didn't know from my previous videos, I will be doing Movember this month to support men's mental health. So I'll be growing a mustache. So if you have any money that you could possibly donate, of course, it's difficult times and I understand that, but if you could donate there, a great charity. Good question from Andrea, I believe it was. It's a tricky one. Personally, I think if the economy of, let's take the UK, because I can give you an example. We've already seen in the UK that in terms of with oil and gas dependency, the UK can run its grid, its national grid, its electricity grid entirely from renewables. It has been shown, they have done it on a couple of occasions, they run the grid entirely on renewables. If the will was there, the political will was there to pursue nuclear power and also to pursue renewable power, I think there is no reason why the UK couldn't be self-sufficient energy-wise within a year or two. Now that might sound quite ambitious, but I honestly don't believe it is. Now, obviously there's political elements to this as well in terms of, well, could you push through nuclear power in a way that's both safe and would get approval in that period of time? Probably not. But I'm more talking about the practicalities, as in if the government were as committed to doing this as they were, for example, during the Second World War to oppose Germany, or as they were, for example, during the recent economic conditions that we have coming out of the pandemic, to push money and to push private businesses into the right direction, I think there's plenty of opportunities for them to do that. And if you think about that kind of logically, if they can do that on an expedited time frame, you could have a situation when in 1, 2, 3 years, energy bills are pretty low. So the primary, or one of the primary causes of inflation at the moment, could be pretty low. A couple of points. So I do actually agree with Surf. Probably in 10 years, if we put in the political stuff, I think that's kind of the objective that they've been saying. What I was saying was in the ideal world, theoretically, how much could they do it? If renewables... yes, to some extent. So obviously renewable as a backup, so using it. So yeah, you would obviously have downtime in terms of with wind and solar. One area that hasn't been explored in the UK at all, and I think this is true for other countries as well, is tidal power. And that has far less downtime, down periods. You can also look at alternative forms of power storage, for example, dams, and for example, using other forms of alternative battery sources in order to store that fuel, which would then release the dependency on imported energy and imported gas and oil. Again, I think the question, I'm not a scientist, but I think that the technology exists, that if the will was enough, you could definitely see a more expedited progression towards renewables and towards alternative fuel sources, which would then end dependence on imported fuel. Yeah, so I think that answers my question. A couple more people joined. I think we're going to be ending the stream soon, but if you do have more questions, please shoot them in now. I think there was an interesting one that came from Andrea there. If not, then thank you all for watching. I hope you enjoyed this. It might have been a bit touch and go. First stream. So thank you for watching. I hope you enjoyed the stream. I'll probably be doing more of these. I find it quite nice to have kind of the interactive stuff. And also I think this medium works a bit better when we have topics which are a bit more complex and have a bit more branching elements to them. So also if you did enjoy it, then I hope that you did. And if you did, I'm glad to hear that. But yeah, I think we'll leave that there. I now have to work out how to turn this thing off. But thank you all for joining, guys. I hope you have a very, very good weekend. And yeah, see you next time.